Okay, let's just jump right into this explainer. If you've been watching the markets lately, you've probably noticed a massive, undeniable wave of capital flowing straight into defense and drone technology. But today, we're going to strip away all those flashy headlines and the hype. We are going to evaluate the actual real-world financial prospects of one specific surging drone stock, Unusual Machines, trading under the ticker UMAC. If you're a potential investor trying to evaluate this company's true financial growth potential, well, this is exactly what you need to hear.
Our agenda for today is pretty straightforward. We're going to cover the recent drone stock surge, scaling for infinite demand, the reality of revenue versus profit, insider confidence, political scrutiny, and finally, the ultimate investor verdict.
So Section 1, the drone stock surge and Pentagon catalysts.
To really understand the excitement here, you just have to wrap your head around this number. Unusual Machine shares are up an astounding 900% since going public in 2024. I mean, they've soared over 100% just year to date. And the most recent spark for all this? The stock took a staggering 57% single-day jump right after a Wall Street Journal report dropped, saying the Pentagon is considering funding multiple U.S. drone companies as part of a $1.1 billion drone dominance initiative. And get this, UMAC was literally the only publicly traded company directly named in that initial report.
Naturally, a rising tide lifts all boats, right? Adjacent defense stocks like Kratos and Axon also saw double-digit daily gains. But the catch is the sky-high valuation multiples the market is assigning across the board right now. Kratos and Axon are trading at absolutely massive price-to-earnings ratios. And Unusual Machines, they're sitting at a forward price-to-sales ratio of 38.64. For an investor, paying a multiple like that demands absolute, flawless execution.
Moving right along to Section 2, scaling for infinite demand, or what we'll call the top-line bull case.
You really can't deny the top-line numbers here. In the first quarter of 2026, UMAC reported sales of $8.1 million. That is a 296% year-over-year growth. But honestly, what's even more important for the bull case is where that money is coming from. Out of that $8.1 million, $7.3 million was business-to-business revenue. That shows a highly successful pivot straight toward enterprise and defense supply chains. And to meet this, they are aggressively scaling. They ballooned their headcount from under 20 people to over 200. They're expanding their Orlando facilities past 100,000 square feet, and they've already initiated $75 million in strategic purchase orders for materials.
The crucial takeaway here is that management views their growth as entirely supply limited. In a recent interview, their CEO, Dr. Alan Evans, flat out said, "We are selling as many parts as humanly possible." He emphasized that military demand is basically swallowing all the inventory they can possibly produce. He even said it creates functionally infinite demand for the next 18 months. As an investor, hearing a CEO say they are limited by supply rather than demand, well, that's pretty much the ultimate growth signal.
All right, Section 3, revenue versus profitability reality. Let's look at the bottom line bear case.
Because, top-line growth is really only half the story. As investors, we have to starkly contrast those record-breaking revenue achievements against some pretty severe operating losses. Yes, UMAC brought in $8.1 million in Q1 revenue, but they also recorded an operating loss of $7.3 million. Now, you might glance at their financials and see a positive headline net income number, but be careful, that was heavily driven by investment gains and interest income, not the core business itself. The reality on the ground is that the company is spending incredibly heavily on operating expenses just to scale up their production and train all those new staff members.
Now, to fund all of this, the company is sitting on an absolute war chest. They reported a very healthy $222.9 million in cash on hand at the end of the first quarter. That kind of capital gives UMAC tremendous runway. It lets them fund this aggressive expansion, buy up huge amounts of inventory, and even pursue acquisitions, like their recent agreement to buy Upgrade Energy. But, and this is a big but, that $222 million didn't just appear out of thin air. It came at a cost to current shareholders. That massive cash position was largely achieved by diluting the existing base. In March 2026 alone, they executed a $150 million equity offering. And while the CEO has pointed out that a lot of their reported losses actually stem from equity compensation rather than just pure cash burn, the company still burned through $38 million in cash over the past 12 months. For a potential investor, this creates a classic tension, right? The company absolutely has the capital to grow, but if management keeps funding that expansion by issuing more stock, shareholders face significant dilution risk. And you really have to consider the massive premium investors are paying for UMAC compared to its peers right now. We're talking a forward price-to-sales ratio of over 38, compared to an industry average of just 3.5. That means the market is already pricing in flawless execution on that infinite demand narrative. There is literally very little margin for error here if they hit supplier delays, quality control issues, or if margin pressures start to creep in.
Which brings us to Section 4, Insider Confidence in Actions, specifically executive trading patterns.
When a company has such an extreme valuation, it is absolutely vital to look at the behavior of the people who know the internal metrics best, the insiders. During that recent massive surge where the stock topped $20 and actually hit an intraday high of $32, the CEO had an open trading window. He holds 1.5 million unlocked shares. And you know what? He chose not to liquidate a single one of them. He even noted in an interview that if he had any real worries about the company's future, he could have easily sold a chunk of his position and completely cleared immediate generational wealth. But he didn't.
So, in an incredibly bullish move, he actually went a step further and canceled his 10b5-1 stock trading plan. If you're not familiar, that's a pre-scheduled plan executives use to sell shares automatically over time. Canceling a pre-scheduled sale during a massive price spike, that is a rare and profound signal of internal confidence. It practically screams to the market that the executive team genuinely believes their operational execution is going to match the current hype.
Section 5. Navigating political scrutiny and evaluating external risks. So beyond the balance sheet and insider behavior, investors also have to neutrally weigh the external political climate surrounding the stock. UMAC's ties have actually attracted direct congressional scrutiny. In March 2026, U.S. Senators Elizabeth Warren and Richard Blumenthal sent a formal letter to the Secretary of Defense directly questioning the Department of Defense's contracting processes regarding companies with specific political ties. Speaking purely impartially here, this high-profile political involvement has to be factored in as a potential compliance risk. The senator's scrutiny specifically cites Donald Trump Jr.'s advisory role and investments in the drone space, which overlaps with Unusual Machines and a drone partner company named Powerinus. Look, regardless of your politics as an investor, you just have to recognize that this level of Washington scrutiny could represent a potential headwind. It could easily create delays when the company's competing to secure those future taxpayer-funded government contracts.
Finally, Section 6, the final investor verdict. Let's weigh the evidence.
We are looking at a classic high-risk, high-reward scenario here. The bull case is firmly anchored by the reality of U.S. supply chain onshoring. UMAC has a heavily fortified balance sheet, massive revenue growth, and an executive team signaling supreme confidence in a market with infinite demand. But the bear case is equally stark. The core business is not yet operating profitably. They have a high cash burn rate resulting in stock dilution. They face external political scrutiny, and they're trading at an extreme price-to-sales valuation that frankly leaves zero room for error. So ultimately, this is the defining question you have to answer before deciding if this drone maker has a place in your portfolio. Can their operational execution catch up to the narrative before that massive cash buffer runs dry? Or is this drone stock just flying a little too close to the sun? Keep a close eye on their upcoming quarterly gross margins and their B2B order flow to find out. Thanks for joining me on this explainer, and as always, keep learning.